Well, I definitely kind of blew it. Probably 162M belonged with the previous section, but it'll fit nicely. Well, we'll pretend it'll fit nicely into the capitalize versus deduct conversation that we're about to have. Okay, well, let's cover 162M. So 162M is a limitation on the amount of compensation that can be deducted for a public corporation. So this is not for anyone who's privately held. You have to be public. And the limit is $1 million, and it's for the CEO, the CFO, and the 3 other officers in the 5 highest paid. So that is actually being expanded. I think next year is when that starts to include another, I believe, 5 more that are going to be limited to $1 million. And so it's not relevant whether it's variable compensation or fixed compensation, salary versus bonus, whatever. It's just the deduction is limited to $1 million. Okay. Now let's talk about what really is the next section, which is capitalize versus deduct. So obviously, one of the things we've talked about is this idea that you can deduct all ordinary necessary business expenses. But one of the things we really left out was this idea that, well, not everything is an expense, right? We know if we buy a building, for example, we don't deduct the cost of a building, right? We capitalize that cost and then depreciate it over time. So when you think about it, capitalize really just means to put it on the balance sheet first, because you do ultimately recover it, right? We're going to recover the basis in that property. We're just going to do it through depreciation, amortization, or depletion. So we really do need to spend at least a little bit of time trying to decipher when do I get to deduct something as an expense and when do I have to capitalize it and recover its cost in some other method. So there's a couple basics. If the expenditure is for an improvement or betterment that increases value, that has to be capitalized. Or if it restores the property to operating condition, so it's fallen out of operating condition and you're repairing it to the point where it now will work again, those are considered to be capitalizable costs. But the rules themselves are actually far more complicated. So a number of years ago, well, more than a number of years ago, maybe nearly 20 years ago, the Treasury Department tried to issue regulations to help taxpayers understand when can they deduct something that's like a repair or maintenance versus when they have to capitalize that cost. Because like I said, a lot of things are pretty simple. Like, I bought a building. I'm pretty sure we got to capitalize the cost of the building. But what if I replace the air conditioning unit in the building? Or what if I own, condos that I lease and I have to replace a refrigerator? Or what if I have to replace an ice maker inside of a refrigerator? So it's kind of like we need to know where to draw these lines. And as it turns out, these lines are pretty difficult to draw. So I'd say a couple decades ago, they failed. And then they tried again, maybe a decade ago, maybe a little less, and they failed again, but they got closer. And then they finally did issue what is commonly referred to as the property regs these days. So I've brought in a KPMG document, and this document is posted as well for your viewing pleasure, that kind of walks through these final property regs that were issued, and it does so with decision trees. Now, I have the KPMG ones, but I'm fairly certain there's a version that was prepared by pretty much all of the large firms, and frankly, even a lot of the firms that are smaller than that prepared, the rules on the property regs. So let's talk briefly. I don't want to spend a ton of time on this because this tends to not be part of the CPA exam, and it is a fairly difficult technical area because there's these things called units of property, and I'm going to try to avoid all that conversation, and really just kind of focus in on probably what is the most important thing. So let's say that we're looking at what we have here, and you can see it's broken down from non-buildings and buildings. So that we already know that, the rules are going to differ a little bit between if it's a non-building versus a building. So then you look at, is it a betterment, right? Because if it's a betterment, you can see, right? This yes comes down and it's going to shift over and say, oh, you need to capitalize that, right? So betterments are required. Is it an adaptation? Meaning, has the property been adapted to a new or different use? Because if so, that's going to follow down and say, hey, you need to capitalize that. And then you get to restorations. And restorations are a little bit trickier. So, this is when does it replace a component for which there was a gain or loss, and return the property to operable condition, which we already discussed, right? And we'd scroll down and say, oh yeah, well, capitalize that, right? If you can say no, then you say, well, does it replace a major component or substantial structural part, or does it rebuild it to a like new condition? And then if you say yes to that, okay, well, you're not going to go exactly, you don't go directly to capitalize. Instead, you'd ask it if it's a network asset, and network is probably not what you're thinking. It's got nothing to do with computer networks. So let's say no to that. We'll just skip that. So did you expect to perform the activity at least twice within the routine maintenance safe harbor testing period, which for buildings is 10 years. For non-buildings, it's the recovery period. So if it's something you'd expect to do twice, then you'd say, okay, well, then go ahead and deduct it. That's a repair. But if not, you got to capitalize that cost. So let me try to explain that particular element really briefly. So typically, a car has a 5-year recovery period. And within those 5 years, you would almost certainly expect to change the oil twice. And so that means that, getting your oil changed is probably a routine maintenance safe harbor because it fits within, you're going to do it twice within the ADS recovery period. Something else you might do is replace the transmission in the auto. Well, that's not something you would routinely do more than one time during the recovery period. So as a result, you would say, oh, I got to capitalize that cost. And rather than hone in on the recovery period for buildings, they just said 10 years. Okay. So then they asked, did the expenditure directly benefit or was it incurred by the reason of another capital activity? So basically that's like, hey, did it, was it part of constructing something else? Because if it was, then you probably need to capitalize it. Okay, so that's kind of the basic capitalize versus deduct. But, there was also a notion, and I'm going to skip buildings, though you should look at this because they're absolutely interesting. What I want to do is get down and talk about safe harbor repair. So here's a couple of safe harbors, and this one is absolutely on the CPA exam. I've seen the questions before, so definitely worthy of taking note of. So there's a de minimis safe harbor, and basically this says, look, if you have applicable financial statements, right, AFS, applicable financial statements, which really means audited financial statements for the most part, you can deduct expenditures up to $5,000 as long as you're doing so for your book policy as well. So if you create a book policy that says, you know what, I don't care what it is, I don't care what it's for, I don't care what it does, if it's $5,000 or less, we're just going to expense it. So imagine, General Electric or Qualcomm or, large with billions of dollars in assets. And obviously their perspective is, look, none of that stuff is material. We just want to write it off. Well, if you do that for book, you can also do that for tax. If you don't have applicable financial statements, so if you're a small business taxpayer, as long as you do it for book, you can write it off up to $2,500. So this is a really important safe harbor because a lot of small businesses can now take advantage of this, where you bought a printer for $300 or $400. You used to have to capitalize it and recover the cost over time, and now you can just write it off under the de minimis safe harbor. You don't need to worry about that. Okay. So that kind of deals with the property regs. So I think we'll just finish the video right here.